Okay, let's unpack this a bit. Imagine a country's, well, its ultimate financial safety net.
Mm.
Maybe a hidden powerhouse that quietly impacts, everything from how much you actually pay for imported goods to the very stability of your entire economy.
Right. It's this critical component, often working behind the scenes for national economic resilience, but its presence or maybe its absence can really dictate a nation's fortune.
Exactly. So today we're taking a deep dive into something called foreign exchange reserves, or FEX for short. We've got a really fantastic stack of sources here that I think lays out the intricate details pretty well.
Yeah, they do. And our mission for you today is really to cut through the jargon, demystify this powerful economic tool.
Mhm.
The goal is you'll walk away understanding exactly what these reserves are, why they're so incredibly important, especially for a dynamic, rapidly developing economy like India's. And then we'll get into the fascinating challenges and maybe the surprising, often indirect opportunities and how they can actually be deployed to serve a nation's goals.
Yeah, it's about seeing that bigger picture, isn't it?
Yeah,
Economic resilience, stability, even a country's global standing.
precisely.
And it's quite a journey we'll take you on. We'll define FEX, trace India's really impressive growth trajectory in building these reserves. Then we'll zoom out a bit, understand their global importance, especially the difference between developed economies and emerging ones, like India.
Right. That distinction is key.
And we'll even tackle that complex, maybe subjective question. Are India's reserves actually enough to handle future storms?
Which is always a tough one to answer definitively.
Definitely. And then, this is where I think it gets really interesting. We'll explore some truly surprising ways these reserves can, and maybe more importantly, cannot be used. It reveals this fascinating economic puzzle. So let's get started. Okay, so to kick us off, for you, our listener, who might be hearing this term, foreign exchange reserves, maybe for the first time, or perhaps just has a vague idea, what exactly are they? How should we really think about them?
Right. So at its core, foreign exchange reserves, or FEX, represent a country's readily available financial holdings. We're talking foreign currencies, physical gold, and other internationally recognized assets. Think of them quite literally as a nation's emergency savings account, a rainy day fund held and managed by its central bank.
Okay.
For India specifically, our sources define FEX as comprising, well, a few key things. The country's gold reserves, its contributions made to the International Monetary Fund, that's the IMF, and something called the fund tranche position, or FTP.
Gold reserves, contributions to the IMF and FTP. Okay, can we break those down just a little?
Sure, gold reserves are pretty straightforward. It's physical gold held as a store of value, a traditional hedge against, currency swings.
Right. The classic safe haven.
Exactly. Contributions to the IMF, that refers to the financial resources a member country like India provides to the IMF. This forms a pool of funds that other members can potentially draw upon if they're in need.
Okay, so it's like paying dues to the club.
Sort of, yeah. And the FTP, the fund tranche position, that's a specific portion of a country's quota with the IMF that it can actually draw upon almost automatically, like
Oh.
without having to meet specific tough economic conditions.
Ah, so like a pre-approved credit line almost?
Precisely, yeah. A very accessible part of their IMF contribution. And crucially, FEX also includes all the foreign currency assets held by the Reserve Bank of India, the RBI.
Got it.
Now, a really key detail here, and something our sources really emphasize, is that while over 90% of these reserves are made up of different foreign currencies, maybe Japanese yen, British pounds, euros, whatever,
Mm-hmm.
their value is all denominated in US dollars.
All in USD. Okay, that's interesting.
Yeah, it means if the RBI holds, say, 100 billion yen, its value for reporting and accounting, it's all translated and presented in USD terms.
So it's basically the RBI, India's central bank, holding this huge, diverse pool of foreign money, plus gold, plus these IMF contributions, but it's all benchmarked against the US dollar. That's quite a statement about the dollar's role.
It is.
But why? Why is that denomination in USD so prevalent, even if they're holding, say, euros or yen? Is it just like convenience, or is there something deeper going on with the dollar's dominance?
That's a really critical point, and yeah, it goes right to the heart of the global financial system as it stands today. The US dollar has held its position as the world's main reserve currency for, well, decades now. It's the dominant currency for international trade, for invoicing goods and services, for most global financial transactions. It's like the undisputed lingua franca of global commerce.
Right, the go-to currency.
Exactly. And this dominance is partly a legacy of the Bretton Woods system set up after World War II. Back then, the dollar was pegged to gold, and other currencies were pegged to the dollar. Even after the gold standard was abandoned in the early 70s, the dollar's role just stuck. Mostly because of the sheer size and stability of the U.S. economy, the depth of its financial markets, and just its widespread acceptance everywhere.
So it just carried on through inertia and network effects, basically.
Pretty much. So for central banks managing these vast sums of foreign exchange, having a universally understood and accepted benchmark is essential for accounting, for reporting, and crucially for ease of deployment in global markets. Think about it. If the RBI needs to make a payment for oil, which is usually priced in dollars, or if it needs to intervene in the currency market to stabilize the rupee, having its reserves denominated and primarily held in dollars just simplifies these operations immensely. It allows for standard measurement, comparison, ensures maximum liquidity, and cuts down on conversion headaches.
Okay.
It's about having that universal benchmark for such critical national assets, really reflecting the dollar's entrenched role as, well, the world's safest and most liquid currency.
That makes perfect sense. A universal language for global finance keeps things running smoothly. Okay, so now that we have a good handle on what these reserves are, let's turn to India's specific story. Because it's not just a set of numbers, it's actually quite a remarkable journey, isn't it?
It really is.
It highlights the nation's economic path over the last few decades and its increasing integration into the world economy. #, India's ascent in foreign exchange reserves.
Yeah, it's a remarkable ascent, one that really underscores India's journey from, quite serious economic vulnerability to a position of significant resilience today. If we look back to 1991, a really pivotal year for India, its foreign exchange reserves stood at a very, very modest level, just USD 5 billion.
5 billion.
Yeah.
Wow.
And just to put that into perspective for you, our listener, that's barely enough to cover a few weeks of essential imports for a large developing nation like India.
That sounds incredibly precarious.
It was. This period represented a severe balance of payments crisis for India. The country was literally on the brink of defaulting on its external debt. Foreign currency was critically scarce. The government had to take some pretty drastic measures, including actually pledging gold reserves to the Bank of England and the Bank of Japan to secure emergency loans from the IMF.
Right, I remember hearing about the gold being flown out, a real low point.
Yeah. It was a time of immense economic pressure, deep introspection. It really revealed a fundamental vulnerability in the system back then.
Okay, so from that crisis point, how did things change?
Well, fast forward a bit, and the landscape changed dramatically. By 2013, those reserves had grown significantly to around USD 275 billion, already getting close to that USD 300 billion mark.
That's a huge jump. What drove that?
It was largely a testament to the economic reforms initiated after 1991. Liberalization, opening up to foreign investment, a greater focus on exports. The economy began to integrate more deeply with the global markets. That led to increased foreign capital inflows, stronger trade balances sometimes, and just generally a more outward-looking economy.
So the reforms really started paying off in terms of building that buffer.
Absolutely. And the growth continued pretty robustly after that. Our sources show it scaled further, touching USD 367.64 billion by October 7, 2016. And then most recently in the data we have here, as of March 2019, India's forex reserves reached USD 401.8 billion.
Wow. So from 5 billion in 91 to over 400 billion by 2019. That's an 80-fold increase in less than 3 decades.
It's truly substantial accumulation over a relatively short period, going from that dire situation in 91 to becoming one of the world's largest reserve holders. It reflects not just economic growth, but also, a conscious strategy by the Reserve Bank of India to build a really robust financial buffer.
That's an incredible surge, yeah. Testament to those reforms and the consistent growth India has seen. But okay, over $400 billion. How does that stack up globally, especially against other major emerging economies or even the big developed ones? Are we talking top-tier player now in absolute numbers, or is there still a significant gap?
That's absolutely crucial, putting India's figures into that broader global context. And our sources give us some good comparative data from around that same time, March 2019. While India's growth is phenomenal, the sheer scale of reserves held by some other major global players is still, it's on a different magnitude. It reflects different economic structures, different strategic priorities over decades.
Okay, like who?
Well, for instance, China. China has long been the world's largest holder of foreign exchange reserves. Back then, it had a staggering USD 3.5 trillion.
3.5 trillion. Wow. That's almost 9 times India's level at the time.
Exactly. An order of magnitude larger. It's a testament to its massive export surpluses and sustained capital inflows over decades. Japan also holds massive reserves around USD 1.5 trillion. Similar story, driven by export prowess and historically a strategy to manage its currency's appreciation.
Okay, so China and Japan are in a league of their own.
Yeah.
What about other emerging economies?
Looking at other significant emerging players, Russia had approximately USD 500 billion around that time, and South Korea had about USD 300 billion. So while India's USD 401.8 billion is certainly a significant achievement, it places it firmly among the larger reserve holders globally. Consistently in the top 5 or 6, it's still considerably lower than giants like China and Japan. And this context is really vital because the absolute size of reserves often dictates the degree of economic maneuverability a country has, the perceived safety, the confidence it can project on the global stage.
Yeah.
It highlights that while India has built a formidable war chest, definitely there are still much, much larger players in the global reserves arena.
That's a really helpful comparative picture. So immense growth for India, yes, making it a serious global player, but also highlighting the truly massive scale of the global reserve landscape and where the real titans stand.
Hmm.
Okay, so beyond just big numbers and rankings, why are these reserves so profoundly crucial for a country like India? What do they actually do for an economy day to day, and perhaps even more critically, in times of crisis?
Right, that's the vital question. This is where the abstract concept of FEX reserves translates into very tangible benefits, protections for a nation and its citizens. The strategic importance goes way beyond just financial accumulation. They are, a bedrock of economic stability, flexibility, and international credibility. Our sources highlight several key aspects, and they all have very real-world implications.
Okay, let's hear them. What's the first big one?
First, and maybe most critically for open economies, economies with substantial cross-border capital flows, both in and out reserves provide a crucial buffer against global fallouts and currency crises. Think of them as a giant shock absorber for the national economy.
Okay.
Without sufficient reserves, a country facing a sudden, sharp outflow of foreign capital, maybe because of local economic jitters or a loss of investor confidence locally, could see its currency just plummet.
And what does a currency crisis actually look like for people on the ground?
Right, let's visualize it. The domestic currency, say the Indian rupee, tanks against the dollar. What happens? Imports everything from essential crude oil to critical pharma ingredients. Even the latest smartphones suddenly become incredibly expensive. This drives up inflation across the board. Businesses that rely on imported components face surging costs. They might have to scale back production, lay off workers, maybe even shut down.
Wow.
Foreign investors, seeing their local assets lose value rapidly, might pull out even more funds, creating a nasty, vicious cycle. For ordinary citizens, well, their purchasing power just evaporates. Imported goods might disappear from shelves. Economic uncertainty spirals.
That sounds disastrous.
It can be. Reserves act as a bulwark against that. They allow the central bank, the RBI in India's case, to intervene by selling foreign currency, like dollars, to support the rupee, preventing that rapid freefall and the domino effect of financial contagion. They buy time and they buy confidence.
Okay, so stability is number one. What else?
Second, they ensure robust import cover. Many essential things for a modern economy, crude oil for energy, critical manufacturing parts, high-tech machinery, specialized medical equipment, they have to be imported.
Right, no country makes absolutely everything.
Exactly. So if a country's foreign currency inflows from exports or foreign investment aren't enough to pay for these vital imports at any given time, the FEX reserves step in. They ensure these imports can still be paid for without disrupting domestic supply chains or production. This directly affects the availability of goods, the stability of domestic prices, the overall continuity of economic activity. Imagine like a critical pharmaceutical ingredient India imports heavily. Without enough FEX to buy it when other foreign cash sources are low, that supply chain could seize up.
Leading to shortages of medicines, maybe.
Precisely. Shortages, soaring prices locally. That's the very real human impact of not having enough import cover. Our sources talk about reserves covering a certain number of months of imports. That's exactly what this metric is about.
Got it. So keeping the essential imports flowing, what's next?
Third, FEX reserves offer freedom to run higher current account deficits, or CADs.
Okay, remind us what a CAD is again.
Sure. A current account deficit basically means a country is importing more goods, services, and income than it's exporting. So more money is flowing out for imports than flowing in from exports on the current account.
Right.
Now, while a large, persistent CAD can be risky if it's financed by volatile short-term capital inflows, hot money, having FEX reserves allows a developing economy like India to sustain somewhat higher deficits without immediate, intense pressure on its currency or risking a sudden stop of capital inflows.
Why is that flexibility important?
It's vital for a growing economy. Often, developing countries need to import capital goods, technology, raw materials to fuel their industrialization and growth, even if their exports haven't fully caught up yet.
So it lets them invest in growth, even if they're temporarily importing more.
Exactly. It means the economy isn't forced to slam the brakes on development just because of a temporary trade imbalance. The reserves provide the buffer to finance that gap safely, assuming the underlying growth story is sound.
Okay, that makes sense. Flexibility for growth. What else do reserves do?
Fourth, they are immensely helpful for debt management. They can be strategically used to retire high-cost foreign currency debt accumulated in the past, or, more commonly, just to meet short-term foreign currency obligations promptly when they fall due.
So pay the bills on time, essentially.
Basically, yes.
Yeah.
But on a national scale, with international creditors, this is all about maintaining financial credibility and avoiding defaults. Imagine a country has a large payment due in dollars to international bondholders, but its immediate dollar earnings from exports are low that month. Reserves provide the immediate liquidity to make that payment, preventing a potential default. And a default, well, that can severely damage a country's international credit rating.
Making it harder and more expensive to borrow later.
Much harder, much more expensive. It can stifle growth and investment for years, so reserves are a crucial tool to prevent that kind of downward spiral.
Okay. Confidence booster for creditors. What else?
Fifth, a robust level of FEX reserves actually strengthens the confidence of the government itself. Confidence to pursue greater economic openness and bolder reforms.
How so?
Well, when a government knows it has a substantial financial cushion, it feels more secure implementing reforms that might be necessary but potentially risky in the short term. Things like further liberalizing capital flows, opening up new sectors to foreign investment, maybe reducing trade barriers.
Things that might cause some short-term volatility.
Exactly. Knowing they have the reserves to handle potential external shocks or the volatility that often accompanies big reforms gives them the political space and confidence to push ahead with policies that can foster long-term growth and attract even more investment down the line.
Right. It emboldens policymakers.
It does. And sixth, directly related to that confidence, healthy reserves increase a country's international credibility and stature. A strong reserve position signals to everyone, international investors, creditors, trading partners, that the country is financially sound, stable, capable of meeting its obligations.
So it makes India a more attractive place to do business with.
Absolutely. A far more attractive destination for foreign direct investment, a more reliable and trusted partner for international trade agreements. It enhances the nation's bargaining power, its overall standing on the global diplomatic and economic stage. It signals, that this is a steady ship in potentially turbulent global waters.
Okay. Credibility on the world stage is their final point.
Yes, and our sources emphasize this particularly for emerging economies. FEX provides the essential hard currency needed for international transactions.
Hard currency meaning?
Meaning currencies like the US dollar, euro, yen currencies that are universally accepted, freely convertible, stable. Unlike economies like the US or Europe, whose own currencies are hard currencies, many emerging economies' domestic currencies are not widely accepted outside their borders for large transactions.
So they can't just pay for imports in rupees, for example.
Not easily, or not for everything, especially large commodity purchases or financial transactions. They need these reserves of hard currency dollars, euros, etc., to pay for imports, to service their foreign debt, to allow their own citizens and companies to invest abroad, and just generally to fully participate in global financial markets. It's not a luxury for them, it's a fundamental requirement for engaging with the global economy. Without hard currency reserves, their ability to trade, borrow, and grow internationally would be severely limited.
Okay, wow. So what does this all mean for us, the listener? It really sounds like FEX reserves are far less about just hoarding money and much more about, well, ensuring a nation's stability, giving it the flexibility to pursue growth, and really enhancing its global standing and credibility.
That's a great summary.
They're a strategic, multifaceted asset. It lets a country like India confidently navigate the complexities, the ups and downs of the global economy, protect its interests, and pursue its growth ambitions without being overly vulnerable to every external shock that comes along. That's a truly comprehensive picture of why they matter so much, way beyond just a big number on a balance sheet. Now, that really comprehensive explanation of why 50x reserves are so vital, particularly for emerging economies, naturally leads to maybe a thought-provoking question. If they're so important, why don't we hear as much about countries like the US, the UK, or the Eurozone actively trying to build up massive stockpiles of these reserves? What's fundamentally different for them? Why is their approach to foreign currency holding so distinct from, say, India's or China's?
This is a really crucial distinction that our sources highlight, and yeah, it gets to the very nature of global finance, currency strength, and ultimately economic sovereignty. The fundamental difference boils down to whether a country possesses a hard currency.
All right, you mentioned that before, a currency that's widely accepted, stable, freely convertible, in high demand internationally.
Exactly. So for developed economies like the US, Japan, or those in the Eurozone using the euro, they already possess these hard currencies, the US dollar, the Japanese yen, the euro. These are in constant circulation and demand globally. This just obviates the need for them to hold large amounts of foreign exchange reserves for their own domestic use in the same way an emerging economy does. When they need to conduct international transactions, well, their own currency is readily accepted by global trading partners and financial institutions.
Okay, so they can just use their own money internationally.
Pretty much. But more importantly, and this is a critical, almost unparalleled advantage they have in adverse circumstances, these economies can effectively print their own hard currency.
Print money. How does that work without causing chaos?
Well, it's not literally printing stacks of cash to pay for imports, but their central banks can create more of their own currency through monetary policy quantitative easing, for example. And because that currency is globally accepted, they can essentially create liquidity internationally when needed. This concept is sometimes called seigniorage, the profit a government makes from issuing currency. But the key is, this just isn't an option for emerging economies. They can only borrow hard currency or earn it through trade. They cannot domestically create it for international use.
Wow. Okay, so the U.S. Fed can create dollars that the world accepts, but the RBI can't just create rupees that the world accepts for oil payments.
Precisely. That ability to issue the world's reserve currency provides an ultimate safety net that emerging economies simply don't have. It's a profound difference in financial autonomy.
Okay, that's a huge difference. Is there another reason reserves don't build up as much in developed economies?
Yes, there's another significant factor. They generally operate with market-determined exchange rates and fully convertible currencies.
Meaning the market sets the price of their currency.
Right. And fully convertible means there are minimal restrictions on exchanging their currency for foreign currency for any purpose, including capital investments. What this means in practice is that all inflows and outflows of foreign currency are naturally matched and absorbed through almost instantaneous changes in the exchange rate.
How does that work? Can you give an example?
Sure, let's use the example from our sources. Imagine a huge inflow of US dollars into Europe. Maybe because American companies are investing heavily there, or there's a surge in global demand for European goods. So more USD is coming into the Eurozone than is being demanded out of it. The market mechanism kicks in immediately. The euro would start to appreciate relative to the dollar, and the dollar would depreciate against the euro.
So each dollar buys fewer euros.
Exactly. And this process would continue until the inflows become less attractive. The appreciating euro makes European exports more expensive for Americans, and American goods cheaper for Europeans, naturally discouraging further inflows and encouraging outflows until equilibrium is reached. The market automatically adjusts, balancing supply and demand, often within seconds or minutes, without the European Central Bank needing to step in and accumulate dollar reserves. It's a self-correcting mechanism.
Okay, the exchange rate does the heavy lifting of balancing flows.
All right. Now, in stark contrast, for emerging economies like India, China, or even historically Japan, the situation is fundamentally different. They often operate with managed exchange rates or have currencies that aren't fully convertible, sometimes both.
Managed, meaning the central bank intervenes.
Yes. India's rupee, for instance, isn't fully convertible on the capital account, meaning there are restrictions on moving large sums of money in and out for investment purposes, and its exchange rate is actively managed by the RBI to prevent excessive volatility. So any intervention by central bank in the free flow of foreign exchange, whether it's trying to maintain a specific exchange rate level, a peg, or simply smoothing out big swings, or if full convertibility is absent, that intervention inevitably leads to the central bank either accumulating or depleting reserves.
Okay, how does it lead to accumulation in India's case?
Well, in India's situation, as our sources state, its exchange rates are managed. When there are significant capital inflows, could be foreign direct investments setting up factories, portfolio investors buying stocks, companies borrowing abroad, external commercial borrowings.
Hmm.
The Reserve Bank of India often steps in and mops up this incoming foreign currency. It essentially buys the incoming dollars or other foreign currency
Why do they do that?
to prevent the rupee from appreciating too rapidly. A rapidly appreciating rupee would make Indian exports more expensive and less competitive in global markets, and it would make imports cheaper, potentially worsening the trade deficit.
Ah, so they buy dollars to keep the rupee from getting too strong.
Exactly. But in the process of buying that foreign currency, the RBI issues an equivalent amount of rupees into the domestic economy. Now, that could be inflationary.
Right, more rupees chasing the same goods.
Precisely. So, to counteract that potential inflationary impact, the RBI often has to engage in what's called sterilization. It sells government bonds in the domestic market to absorb those excess rupees it just created.
Okay, so buying dollars builds reserves, selling bonds mops up the rupees. It's quite a balancing act.
It is, but the net effect of managing the exchange rate against strong inflows is that the foreign exchange reserves build up. And furthermore, even if a country like India has a current account deficit, importing more than exporting if there are sufficient surpluses on the capital account, that's the foreign investment, loans, remittances, etc.
Hmm.
Those capital surpluses can not only cover the current account deficit, but can actually lead to an increase in overall foreign exchange reserves. This kind of reserve buildup also happens quite prominently in economies that maybe lack the domestic capacity to fully absorb all the incoming foreign currency productively, or in economies that consistently run large current account surpluses but maintain pegged exchange rates or non-convertible currencies.
Like China and Japan, which you mentioned, have huge reserves.
Exactly. That's been a big part of their story, especially China's. They've actively managed their currencies, often keeping them somewhat undervalued to support their export-led growth models, and the massive accumulation of reserves is a direct consequence of that long-term policy choice.
Okay, that's a fascinating and really crucial distinction. So it's not just about how much money a country has, but critically, what kind of money it is it a global hard currency? And how does its currency interact with the global market? Is it free-floating or managed? It sounds like holding substantial reserves isn't just a choice, but almost a necessary proactive strategy for emerging economies. It's about managing volatility, ensuring a degree of economic independence, and safeguarding national interests when you don't have the luxury of a universally accepted, freely convertible currency, or that ultimate safety net of being able to effectively print it for international use.
You've got it. It's pragmatic management of their external sector in a world still largely dominated by a few key hard currencies.
Right. So with all this discussion about India's impressive growth in reserves and their profound importance, a critical and, I imagine, often debated question comes up. Is India's current reserve accumulation actually sufficient? Sufficient to ward off any crisis? How do we even begin to measure enough when crises are, well, by definition, pretty unpredictable in their nature and their potential impact? It feels like trying to put a number on, preparedness for the unknown.
That's exactly the million-dollar question, maybe the multi-billion-dollar question. And you're right, it's far more complex than finding a single fixed number. Our sources make it abundantly clear. Crises are inherently unpredictable. Their magnitude, what triggers them, the extent of damage they can inflict. It's all highly variable. So determining sufficiency is less about a static quantitative target and more about a dynamic qualitative assessment.
Qualitative meaning, based on perception and judgment.
Largely, yes. It's often based on the government's and the central bank's perception of risk, the lessons learned from past crises, both domestic and international. And as history shows, each successive major crisis tends to raise the bar for what's considered enough.
Yeah, like after the Asian financial crisis in the late 90s.
Exactly. What was considered adequate before that crisis was clearly proven insufficient during it. That led many emerging economies, including India, to much more aggressively build up reserves afterwards. It's an evolving standard based on painful experience.
Okay, so it's partly subjective and always evolving. But surely there must be some benchmarks or rules of thumb that economists use.
Oh, yes, absolutely. Despite the unpredictability, over time, with experience and theoretical work, some international benchmarks have been developed and prescribed to help gauge the sufficiency of reserves, particularly for emerging economies. Let's walk through the key ones our sources outline.
Okay, let's hear them.
The first, and probably the most widely cited, is import cover. This benchmark suggests, quite simply, that a country's reserves should be able to cover at least 3 months of its average imports.
Why 3 months?
It's a very practical rule of thumb. It essentially ensures that even if all other sources of foreign currency, like exports or capital inflows, were to suddenly dry up completely, the country could still pay for its essential imports for a quarter of a year.
Okay, gives you some breathing room.
Yeah.
How does India stack up on that?
Our sources indicate that at the time of the data, India's reserves provided a comfortable cover of about 7 months.
7 months, that's well above the 3-month minimum.
It is. Now, the source does note this was down from a previous peak of 15 months, which was an exceptionally high level, but 7 months is still considered a very robust cushion. It offers significant protection against temporary disruptions in financing essential imports.
Okay, so good on import cover. What's the next benchmark?
And the second one is external debt cover. The general recommendation here is that a country's reserves should cover at least 75% of its total external debt, and perhaps more importantly, ideally 100% of its short-term external debt.
Why the focus on short-term debt?
Because short-term debt is particularly vulnerable during a crisis. It matures quickly, often within a year, and needs to be either rolled over, meaning refinanced, or repaid in foreign currency. If market sentiment turns negative, refinancing can become very difficult or expensive, so having reserves to cover it provides a critical safety net against default.
Right. So how does India fare on debt cover?
Very strong, according to our sources. Its level of reserves is reported to be much higher than the prescribed 50% for overall external debt cover mentioned in one part of the source analysis, and significantly above 100% cover for short-term debt specifically.
So low risk of being unable to pay foreign debts quickly.
That's the indication, yes. It provides major comfort to international creditors and investors about India's ability to meet its financial obligations without undue stress.
Okay. Import cover, debt cover. What else?
Third, there's something called the Guidotti Rule. It's named after Pablo Guidotti, a former deputy minister of finance in Argentina. This rule suggests that the ratio of a country's average reserve holdings to its short-term external debt, usually measured over a year, should be a minimum of 1. Basically, you should have enough liquid reserves on hand to cover all your short-term foreign currency obligations coming due within a year.
Okay, reserves should equal short-term debt. Makes intuitive sense. How's India doing there?
Impressively, again, the source states India's ratio is 5, meaning India holds reserves equivalent to 5 times its short-term external debt.
5 times? That sounds incredibly strong.
It does on paper. It suggests a very, very low risk of a short-term liquidity crunch related to foreign debt. However, and this is a crucial caveat, the source makes explicit that Guidotti rule has not been tested and has yet to prove its worth.
What does that mean, not tested?
It means that while it's a theoretical benchmark, a major global financial crisis hasn't yet unfolded in a way that definitively validates its predictive power or its effectiveness as a preventative measure. So we don't actually know for sure if maintaining a ratio of 1 or even 5 guarantees safety in a real severe systemic crisis. It underscores the limitations of even these seemingly sensible models.
Right. Theory versus messy reality. Is there a final benchmark mentioned?
Yes, there's the liquidity at risk LAR model. This one was popularized by Alan Greenspan, the influential former chair of the U.S. Federal Reserve. The LAR model is described as a more dynamic statistical approach. It tries to map out the likely outflows of foreign currency from a country under various different adverse scenarios.
It's like simulating different types of crises.
Exactly. It might model scenarios like a sharp fall in global commodity prices, a sudden flight of hot money capital, a global recession, maybe geopolitical shocks. And it factors in different levels of probability for these events occurring and different confidence levels for the estimates.
So it tries to calculate potential reserve drain under stress.
Yes, that's the idea. And the LAR model is designed to be continuously modified based on evolving assumptions about economic conditions, market volatility, potential external shocks. It's meant to be adaptive.
Sounds quite sophisticated. Does it work?
Well, again, similar to the Goudori rule, our sources highlight that the LAR model has not been tested and has yet to prove its worth. Its sophistication lies in its dynamic nature, its attempt to capture complex interactions.
Right.
But its predictive accuracy in the face of truly novel or unprecedented black swan-type crises remains unproven.
This then leads us to wonder. So even with these established benchmarks, like import cover and debt cover, and even sophisticated models like Greenspan's LAR, there's still this significant layer of uncertainty, isn't there? Because real-world crises just don't always follow the neat rules or statistical predictions laid out in models.
That's absolutely right.
It sounds like the approach for policymakers then is maybe less about hitting a magic number and more about building layers of resilience based on historical lessons, using these benchmarks as guides, but ultimately aiming for a level of preparedness that feels robust enough to handle the unforeseen, rather than relying solely on predicting the future based on models.
I think that's a very accurate way to put it. Preparedness, not precise prediction.
And what's truly insightful here, I think, is realizing that even the most sophisticated economic models designed by brilliant minds come with this inherent humility. They're tools for understanding risk, maybe managing it better, but they're not crystal balls for predicting every storm. It really underscores that building economic resilience is an ongoing adaptive process, not some final destination you reach just by hitting a fixed number on a spreadsheet.
Okay, absolutely. So now let's get to what many people might consider the big question, perhaps even an intriguing paradox. How can India actually use these massive reserves? You'd intuitively think, wow, hundreds of billions of dollars in foreign currency. That must be a simple, straightforward solution to so many pressing economic challenges like, funding massive infrastructure projects, stimulating domestic growth, maybe bolstering social programs. But it's not that simple, is it? It seems to be a far more complex puzzle with a pretty significant limitations.
You've hit on a really critical point, and yeah, it's precisely where the theory of foreign exchange reserves meets the hard reality of economic policy. And it's where the most common misconceptions tend to arise. There's a major, almost ironclad limitation in how these reserves can be directly utilized for domestic spending. And it's this. They can only be utilized in foreign currency. Our sources are very, very clear on this.
Only in foreign currency. Why can't the RBI just, exchange the dollars for rupees and spend them domestically?
The reason is fundamentally about maintaining monetary stability, specifically controlling inflation.
Corey, explain that link.
Imagine the Reserve Bank of India decides to sell, say, just $1 billion from its reserves. And in return, it injects the equivalent amount in rupees tens of thousands of crores directly into the Indian economy. This sudden, massive surge of new rupees starts circulating in the domestic system, but there hasn't been a corresponding immediate increase in the amount of goods and services available to buy.
Right. More money chasing the same stuff.
Exactly. That almost inevitably leads to significant inflationary pressures. Prices start going up across the board, eroding the purchasing power of every single Indian rupee already in circulation. And since the central bank's primary mandate, its core job, is ensuring price stability, directly converting reserves for domestic spending would fundamentally undermine that core function. It's basically a non-starter if you want to maintain macroeconomic balance.
Okay, that's a huge constraint. So you can't just spend the reserves domestically by converting them to rupees because it would cause inflation.
Got it. So given that fundamental limitation, let's look at some of the direct uses that are sometimes proposed. Why aren't they straightforward solutions for India?
Right. Let's tackle them. First, what about liquidating external debt? Using the reserves to pay off foreign loans.
That sounds logical. Debt is usually in foreign currency, right? It often is, and reserves can certainly be used for this purpose. Our sources point out, though, that India has actually already, quite successfully, retired much of its really high-cost foreign currency debt from earlier periods, like the 90s. Furthermore, there's a complication. The problem with simply using reserves to liquidate external debt is that it often requires the government to increase its internal debt.
How so?
Well, the government would essentially need to borrow an equivalent amount in rupees from the domestic market by issuing bonds to buy the foreign currency, dollars, from the RBI to then repay the foreign debt.
Ah, so you're just swapping foreign debt for domestic debt.
Exactly. It merely shifts the debt burden from foreign creditors to domestic ones. It leaves the overall debt position of the country largely unchanged, only altered in its composition, rupee versus dollar, and who holds it. It doesn't fundamentally reduce the nation's total indebtedness, just its vulnerability to foreign exchange fluctuations on that specific portion of debt.
Okay, so not a magic bullet for reducing overall debt. What about using reserves indirectly by, say, lowering import duties or deliberately running higher current account deficits, CADs, letting more imports flow in to absorb the reserves?
That's another theoretical possibility. More imports mean more demand for foreign currency, which could naturally draw down reserves. But it comes with significant trade-offs. Lowering import duties too much, beyond a certain optimal level, could severely hurt nascent or vulnerable domestic industries. Local producers might not be able to compete with cheaper imports.
Potentially leading to job losses and harming local manufacturing.
Yes, potentially deindustrialization in some sectors. And as we discussed earlier, while a CAD can be beneficial if it's financing productive investment, deliberately running a persistently high CAD is always fraught with risk. It can make the economy highly vulnerable to sudden shifts in investor sentiment, leading to capital outflows and currency depreciation, potentially triggering the very crisis scenarios the reserves are meant to prevent in the first place. It's a really delicate balancing act.
Okay, so potentially harmful side effects there too. What about the idea of the RBI just directly lending the reserves for, say, big infrastructure projects?
Right. That comes up sometimes. But the third point is the Reserve Bank of India simply cannot lend commercially. It's not its role.
Why not? It has the money.
Because its role as a central bank is fundamentally different from a commercial bank. Its job is to regulate the banking system, manage monetary policy, like inflation and interest rates, ensure financial stability, and act as a lender of last resort to commercial banks, not to businesses or projects directly. If the RBI were to bypass the commercial banking system and lend foreign currency directly to, say, an infrastructure company, that money would still eventually find its way into the broader economy when the company spends it, even if initially on imports. It would inject liquidity and, once again, create those inflationary pressures we talked about.
So it's fundamentally outside its mandate and would distort the economy.
Correct. It would lead to severe macroeconomic distortions and undermine its primary role. So, it cannot directly fund the building of roads, ports, or power plants by lending from reserves.
That's fascinating and really quite the irony, isn't it? Here's where it gets, I think, really interesting for our listeners.
Yeah.
India is a country famously investment starved, right? There's this massive acknowledged need for infrastructure development, roads, power, ports to sustain its growth.
Absolutely, a huge need.
But these vast reserves sitting there like a treasure chest full of foreign currency seemingly can't be directly used to bridge that investment deficit or fund that crucial infrastructure within the country because of the fundamental risk of causing inflation if converted to rupees.
That's the core paradox.
So if direct use is largely out of the question, what has been done? How are these reserves currently being deployed? And has there been any creative way found to leverage them for India's domestic needs without triggering that inflation bomb?
Yes, absolutely. Given these fundamental limitations, the Indian government and the RBI have adopted a prudent strategy for deploying the reserves internationally. The main goal is ensuring liquidity and safety, even if it means generating relatively lower returns compared to riskier investments.
Okay, so where are they actually invested?
Our sources tell us that the reserves are partly deployed in highly liquid and extremely secure U.S. Treasury bills, generally considered among the safest assets in the world, and partly in global sovereign bonds issued by other highly rated governments.
So safety first.
Safety and guaranteed liquidity take absolute precedence over maximizing returns. Because remember, the primary purpose of reserves is macroeconomic stability, providing that robust buffer, not generating big profits. They are the national safety net, not a speculative investment fund.
Right, stability over yield. Makes sense. But you mentioned innovation. Did they find a way around the no domestic spending rule for infrastructure?
They did, and it's quite clever. Recognizing the very limitation you highlighted, the inability to directly convert reserves for domestic investment, the Indian government took a very innovative and intelligent step to indirectly leverage these reserves for infrastructure development. It set up the Deepak Parekh Committee specifically to examine how these massive reserves could be strategically utilized or channeled towards India's critical infrastructure needs without causing those inflationary pressures.
Okay, the Deepak Parekh Committee, what did they recommend?
Based on their recommendations, which were accepted and implemented by the government, a really clever multi-layered mechanism was put in place. It's a bit complex, but let's break it down.
Please do.
First, the India Infrastructure Finance Co., LTD, that's IIFCL, a wholly owned government entity focused purely on infrastructure financing, was authorized to borrow a substantial amount, USD 10 billion, according to our source, directly from the RBI.
Okay, but how? Didn't we just say the RBI can't lend commercially?
Good question. This was structured as a foreign currency loan from the RBI's reserves to IFCL. Critically, the RBI wasn't converting reserves to rupees, it was lending dollars to another government entity. This avoided injecting rupees into the domestic system.
Okay, so it's a dollar loan between government arms staying in foreign currency. Yeah. What did IFCL do with the dollars?
Right. Then IFCL went a crucial step further to manage and deploy these funds effectively on the global stage. It set up two wholly owned subsidiaries, often called WOS overseas. One was set up in London and one in Singapore.
Okay, overseas subsidiaries, what were their roles?
The London WOS was designed with a very specific mandate to provide loans directly in foreign currency to Indian companies. But, and here's the key condition, only to those Indian companies that were raising funds overseas specifically for capital imports that would be directly used for infrastructure projects back in India.
Okay, let me make sure I understand. An Indian company needs, say, a giant tunnel boring machine from Germany for a metro project. It needs euros or dollars to pay the German company. So instead of borrowing commercially overseas, it could borrow the necessary foreign currency from this IFCL subsidiary in London.
Precisely. The foreign currency from India's reserves, flowing through IFCL and its London subsidiary, was directly facilitating the import of critical equipment and machinery needed for domestic infrastructure projects. And crucially, it did this without ever touching the rupee market domestically or causing inflationary pressure. It's like using a foreign currency bridge to bring in essential foreign goods.
That is clever.
Oh.
Okay, what about this Singapore subsidiary? What did it do?
The Singapore WOS had an even more innovative, perhaps less obvious role. It was tasked with taking a portion of these borrowed funds and investing them very securely in things like AAA-rated bonds or paper of top global companies, very safe investments generating stable returns.
Okay, investing safely. But how did that help infrastructure back home?
Here's the clever part. From the stable, secure returns generated on these international investments, the Singapore WS would then provide something called a credit wrap, or monoline insurance.
Credit wrap. Monoline insurance? What's that?
Think of it as a financial guarantee. Essentially, it's insurance against default for other Indian companies that were trying to access the overseas market to borrow foreign currency for domestic infrastructural development.
So it wasn't lending directly, but making it easier for others to borrow.
Exactly. This credit wrap, provided by the Singapore WS, significantly reduces the perceived risk for foreign lenders when lending to these Indian infrastructure companies. If the Indian company defaults, the insurer, backed by the returns from the Singapore WS investments, steps in.
So it makes borrowing cheaper and easier for Indian companies needing foreign funds for infra.
Much cheaper and much easier. It lowers their borrowing costs significantly and increases their access to large pools of global capital, all indirectly backed by India's reserves, again, without converting those reserves into rupees or causing inflation.
That's truly a creative and frankly ingenious way to get around that fundamental cannot convert to home currency rule. By using the reserves to facilitate overseas borrowing, facilitate capital imports, and de-risk foreign investment for domestic needs, it indirectly channels the power of these reserves into critical infrastructure without upsetting the domestic monetary balance. It's like using a global financial bridge and insurance scheme rather than trying to build a domestic financial dam with foreign currency.
That's a very good analogy.
But, okay, that's the current strategy, or at least the one implemented based on the PEREC committee. Are there other, perhaps bolder ideas out there for how India could potentially utilize these reserves, looking beyond this albeit clever current strategy?
Absolutely. Our sources do discuss other strategic options that have been considered or proposed for reserve utilization. These point towards a broader, maybe more ambitious vision for how these significant assets could serve India's future and potentially even the wider regions. These ideas often involve different risk-reward profiles and different strategic objectives compared to just holding reserves purely for stability.
Okay, what's the first one?
One prominent option that comes up globally is the establishment of sovereign wealth funds, or SWFs.
Right, we hear about those Norway, Singapore, Middle Eastern countries.
Exactly. Many countries, particularly those with vast commodity surpluses, like oil producers, or massive reserve accumulations like China, Japan, Saudi Arabia, and Norway, have deployed deployed a portion, sometimes a significant portion of their reserves into SWFs. Now, the primary objective of these funds is fundamentally different from traditional central bank reserves. SWFs aim to maximize long-term returns on their investments. They often do this by taking on more calculated risk rather than just focusing on currency stabilization and immediate liquidity like central bank reserves do.
So they invest more like a big pension fund or endowment.
Precisely. They invest in a very diverse range of assets globally: stocks, bonds, real estate, private equity, infrastructure projects abroad, all with the goal of generating intergenerational wealth or achieving specific long-term national financial objectives. Norway's government pension fund Global is a massive and often cited successful example, investing its oil revenues for the long-term benefit of its citizens.
Okay, so why hasn't India jumped into creating a huge SWF with its reserves?
Well, there are a few points raised in our sources. First, there's a general caveat about SWFs. Many of them tend to lack transparency. Their exact investment strategies, their decision-making processes, their specific holdings beyond broad objectives are often opaque, not fully known to the public. This can raise concerns about governance, accountability, maybe even political influence on investment decisions.
Okay, transparency issues. But are there India-specific reasons?
Yes, our sources suggest that for India, establishing a large-scale SWF funded significantly from its current forex reserves might be considered premature.
Premature, why?
Several reasons are cited. First, the inherent volatility of India's capital inflows compared to, say, consistent trade surpluses in China. Second, India's historically more fragile balance of payments (BOP) situation overall. Third, its persistent current account deficit (CAD), which constantly needs financing, unlike surplus countries. And fourth, relatively modest export growth compared to export powerhouses. These factors collectively make it a riskier proposition for India to lock up a significant portion of its reserves needed for stability into potentially less liquid, longer-term SWF investments, especially compared to countries like China and Japan, whose reserve holdings are many multiples larger than India's, and whose underlying BOP structures are fundamentally much stronger due to those huge, consistent trade surpluses.
So India needs its reserves more for immediate stability than long-term investment gains right now.
That seems to be the argument presented. And most importantly, India has pressing needs for its reserves, stabilizing the economy, managing the currency, and facilitating critical domestic infrastructure development, like through the IFCL route. SWFs are generally not designed to directly address those immediate domestic priorities. Their focus is typically on long-term global financial returns.
Okay, so SWF might be a future option, but maybe not the right fit just yet, given India's specific circumstances and priorities. What's another potential use?
Another very practical and strategically vital option discussed is the creation of strategic oil reserves, SOR, using forex reserves.
Building up a national stockpile of oil.
Exactly. Given India's profound dependence on imported crude petroleum, it's one of the world's largest importers, and its inherent vulnerability to global oil price volatility and potential supply disruption.
Yeah, oil prices affect everything in India.
They really do. So the idea is that a significant portion of the foreign exchange reserves could be strategically used to build up an SRR. This would involve using dollars from the reserves to purchase crude oil, particularly when international prices are relatively low, and then storing it securely, perhaps in underground caverns or other dedicated facilities.
Creating a physical buffer against price shocks or supply cuts.
Precisely. This physical stockpile could then be drawn upon during periods of sharp upward spikes in international crude prices, or perhaps more critically, during times of geopolitical instability that might affect oil supply routes. This directly addresses a major, persistent economic vulnerability for India. It would reduce the impact of volatile oil price shocks on the domestic economy, on inflation, on the government's fiscal balances. It provides a tangible form of energy security and a crucial strategic advantage, allowing India to weather global energy storms much more effectively.
That seems like a very direct and strategic use of reserves to mitigate a known risk. Has India done much of this?
India has built some strategic petroleum reserves, but the argument is that perhaps a larger portion of forex reserves could be dedicated to expanding this capacity significantly, given the scale of its import dependence.
Okay, SWFs, SOR. Is there a third major idea?
Yes, and this one is perhaps the most ambitious and forward-looking, with significant geopolitical implications. The establishment of an Asian Development Fund, ADF.
The Asian Development Fund. like a regional version of the IMF.
Sort of, yes, that's the parallel often drawn. Consider this remarkable statistic highlighted in the sources. Just three major Asian economies, China, Japan, and India, collectively hold a staggering USD 6 trillion of the roughly USD 15 trillion global foreign exchange reserves.
Wow, 6 trillion out of 15 trillion, that's nearly 40% of the world's total reserves, held just by those three.
It's an immense concentration of financial power in Asia. So, the proposal is, what if these three major Asian economies could agree to pool a defined part of their vast reserves, maybe a percentage that doesn't compromise their own individual stability, needs to set up an ADF? This fund could then function much like a regional financial safety net. It could provide essential financial assistance, loans and hard currency to other emerging economies in Asia should they face currency problems, balance of payments crises, or other severe financial difficulties.
So Asian countries helping other Asian countries in crisis using their own pooled reserves.
Exactly. This concept carries immense strategic significance. It aligns perfectly with the undeniable gradual shifting of global economic output and trade power towards Asian economies. Such a fund could significantly enhance regional financial stability, potentially reduce the region's reliance on Western-dominated institutions like the IMF for financial assistance, which sometimes comes with conditions perceived as onerous or inappropriate, and maybe foster greater economic integration and cooperation within Asia itself.
It sounds like it would give these Asian giants, China, Japan, India, a powerful tool for regional leadership and crisis management, reflecting their growing economic weight.
It absolutely would. However, and the source is very clear and realistic about this, making this ambitious vision a reality would face formidable challenges. It would require a significant meeting of political minds, setting aside differences and a more mature outlook from all the involved countries.
Yeah, given the complex historical relationships and ongoing geopolitical rivalries in the region, that sounds like a massive understatement.
It is indeed a huge political hurdle, but the economic logic leveraging that vast pool of shared reserves for regional stability is compelling. It's an idea that really speaks to the growing financial cloud of Asia, but one that requires unprecedented levels of trust and cooperation to even begin to implement.
This then leads us to wonder. So, while India's current approach to using its reserves for infrastructure via IIFCL is incredibly clever and pragmatic, these other ideas really broaden the horizon, don't they? Whether it's the long-term investment philosophy of sovereign wealth funds, the immediate strategic benefit of a larger oil reserve to enhance energy security, or even this grand, potentially transformative vision of an Asian IMF. They point to a much broader, more strategic potential for how these massive financial assets could shape not just India's future economic trajectory, but potentially the entire region's economic stability and its collective influence on the global stage.
It's really about leveraging financial power for both crucial domestic progress and potentially wider geopolitical goals. Hashtag outros.
Yeah, and if we just take a step back and connect this all to the bigger picture, India's foreign exchange reserves have indeed come a remarkably long way from that incredibly modest, almost perilous USD 5 billion back in 1991.
Right, a near crisis level to hundreds of billions today. This journey from vulnerability to significant resilience, culminating in this large reserve cushion, provides undeniable comfort on the external front. It acts as that robust financial safety net we talked about at the start. It has definitely built immense confidence within the government, among international investors, rating agencies. It enables India to weather turbulent domestic periods and, perhaps more importantly, global economic fallouts with much greater stability than before. It's truly a testament to decades of, careful economic management, significant reforms, and sustained growth.
Absolutely. We started this deep dive by calling these reserves a country's financial safety net. But I think what we've really unpacked today shows there's so much more than just that. They're a critical strategic tool, aren't they? A crucial marker of global standing and credibility, and really a testament to a nation's evolving economic resilience and its ability to manage its place in a complex world. Hopefully, for you listening, you now have a clearer, maybe far more nuanced understanding of this critical, yet often unseen, part of India's economic machinery and its increasingly influential place on the global stage.
And perhaps this leaves us with an important question to ponder. As global dynamics continue to shift, trade patterns changing, geopolitical tensions rising, the digital economy evolving, and as the economic power and strategic role of emerging economies like India undoubtedly continue to grow.
Oh.
Will the international benchmarks for reserve sufficiency, those rules of thumb like import cover or the Gurdari rule, need to evolve further? Will they prove robust enough, or will we need new metrics beyond these current, somewhat untested ones?
A very relevant question.
And perhaps alongside that, will we see even more innovative, maybe even more cooperative approaches to deploying these powerful financial assets? Approaches that go beyond just national stability and address both pressing domestic needs like infrastructure or energy security, and maybe broader geopolitical aspirations for a more stable, perhaps more multipolar global financial system.
That's fascinating. Will the tools and strategies for managing these massive pools of national wealth need to become as dynamic and complex as the world itself? Something fascinating to mull over as you continue to think about the global economic landscape and the subtle, yet truly immense power held within these foreign exchange reserves. That's all the time we have for this deep dive. Until next time, keep learning, keep questioning, and keep exploring the fascinating world around us.